Hi there, I'm Adrian Alisie and I'm a certified public accountant practicing in the Villages community in Central Florida. This is a new episode in our series of short videos on key taxation concepts designed specifically for retirees, and today we are continuing our discussion covering the various types of retirement incomes. In our previous video, we covered Social Security benefits and pensions. This video will explore additional sources of retirement income, such as annuities and distribution from retirement accounts. In the third and last video covering this topic, we'll discuss other common income types applicable to retirees, such as capital gains, dividends, interest received, rental income, and more. So let's talk about annuities and break down how they are actually taxed. Annuities are insurance products that you purchase from insurance companies. They are very popular among retirees because they provide predictable, steady income, often for life. The way annuities are funded determine their tax treatment. So, for instance, if you buy an annuity with pre-tax dollars, usually from an IRA or 401k account, all payments received are taxed as ordinary income because the funds were never taxed up to that point. These are also called qualified annuities. On the other hand, if you funded your annuity with after-tax dollars, such as personal savings or non-retirement accounts, only the earnings or growth component of the payments received is taxed, and your original contribution remains tax-free. These are also called non-qualified annuities. There are also Roth annuities, which are qualified annuities funded with after-tax dollars. Most of these are funded from Roth IRA accounts and must comply with Roth IRA regulations. In those cases, both your contributions and earnings can be withdrawn completely tax-free. Obviously, the key purpose of annuities is to convert a lump sum of savings into monthly income, which reduces some of the concerns many retirees have about outliving their financial reserves. However, it is important to understand how those products are taxed, as it will significantly impact your after-tax income. All right, now let's go through an example to highlight some of the points we've been talking about. Suppose you retired and decided to buy a qualified immediate annuity, funding it with $200,000 from your IRA account. In return, you begin receiving $1,200 per month immediately. Because the $200,000 came from a pre-tax IRA, every payment received is taxed as ordinary income, and you'll pay income tax on the full $1,200 each month. Now, let's say you used $200,000 from your personal saving after-tax dollars to buy a similar annuity. Your monthly payment might still be $1,200, but only the earnings or growth portion of the payment received would be taxable. Annuities is one of the important tools used in tax planning, and we will revisit this topic in one of our tax strategy for retirees future videos. Now, the second type of retirement income discussed today is the retirement accounts distributions. Distributions from traditional IRAs and 401k plans are common sources of retirement income. As most of you know, these accounts are funded with pre-tax dollars, so withdrawals are taxed as ordinary income when taken out. One advantage of this distribution is that generally you control when, how much to withdraw, allowing for flexible tax planning. However, starting at age 73, you are required to take minimum withdrawals called required minimum distributions or RMDs each year. The purpose of the RMDs is to ensure that you pay taxes on these tax-deferred savings during your lifetime. If the minimum required amount is not withdrawn, a penalty of 25% of the missed distribution amount applies, which can be reduced to 10% if the issue is corrected promptly. The RMD is calculated through a fairly simple formula and is based on prior year and account balance and the life expectancy factor provided by IRS. This factor is derived from actuarial data, which involves analysis of lifespan based on a number of factors such as age, gender, and many other. Now, let's go through an example to make this concept clearer. Suppose you turn 73 in 2025 and your IRA balance on December 31st, 2024 was $500,000. We obtain your life expectancy factor from IRA tables, and for age 73 the factor is 26.5. We divide your prior year-end balance by the IRS life expectancy factor, or 500,000 divided by 26.5, and equals $18,867.92. So your RMD for 2025, it is $18,867.92. You should withdraw at least this amount by December 31st, 2025. However, there is an exemption for your first ever RMD, for which the deadline can be extended to 1st of April of the following year. As you withdraw the funds from year to year, your account balance decreases and your RMD will decrease. Now, this is it for today. Thank you for joining me, and I look forward to wrapping up our discussion on the different types of retirement incomes in our next video.